I'm Meg Green with AM Best TV. Welcome to today's webinar, The State of the Global Reinsurance Market. Our main discussion has been pre-recorded. Because Hurricane Dorian's track is not fully established, AM Best has paused its commentary on the storm's impact on reinsurers and the U.S. primary insurance market. AM Best's most recent commentary, Intensifying Hurricane Dorian Poses a Significant Threat to Florida's Atlantic Coast, was released on August 30th. You can find it at ambest.com/research. We are closely monitoring the effects of Dorian as it proceeds. Additional reports and commentary will be issued as the situation develops. We have a full program and a strong panel, which we'll meet in a minute. We may discuss the topic of insurance ratings during the broadcast. For an explanation of AM Best and its role as a regulated rating agency, please visit ambest.com/terms. Also, our panel is comprised of several AM Best rating analysts and several industry participants. Statements made by our non-AM Best participants are theirs alone and do not reflect the viewpoint of AM Best. This webinar has been pre-recorded, so we can't respond to your comments during the broadcast. However, if you have questions or comments, please send them to webinars@ambest.com and we'll forward them to the appropriate contact. Thank you, and let's meet our panel. Joining us today, we have Mario Bonaccorso, Chief Financial Officer of Partner Re, Mark Kosiancic, Chief Financial Officer of SCORE, Bob DeRose, Senior Director, AM Best, Scott Mangan, Associate Director, AM Best. Thank you all for speaking with us today.
Thank you, Meg.
So could we start with sort of an overview? What is your assessment of the current reinsurance environment and the factors shaping it?
Well, maybe I'll lead off. As you know, Meg, in January, AM Best revised its outlook on the global reinsurance market from negative to stable. And I do want to emphasize that it's a market outlook, not a rating outlook. The reason why we went stable is not necessarily because we felt the environment had improved substantially, but rather because we felt that following the events of 17 and 18, that pricing was more likely to stabilize and that return metrics probably did hit bottom for the sector. So January renewals showed a little bit of promise, not as much as we would have hoped, but certainly the June renewals were more promising. I think the thing that one has to keep in mind is that the improvement has been isolated. Not all classes of business and segments, improved to the same degree, but certainly, loss-affected U.S. property cat, and Asian cat classes of business showed the most dynamic improvement. And the other important factor to consider is that alternative capital appears to be more disciplined, and hopefully that will remain the case going forward, and that should bear well for pricing over the near term.
I'd say we're probably in a more challenging and complex environment. We definitely have more loss severity that we've seen in the last couple of years. We've got risks that are increasingly more complex, such as cyber, even terrorism. And then you complicate that with the fact that we've got a low interest rate environment that's been created more recently over the last 10 years. And then I think you can couple that with the fact that you've got the impact of technology on the industry that's increasing rapidly and changing the way we're distributing and underwriting in the sector. So overall, I'd say there's a greater emphasis on creating value for your clients, understanding the risks, and emphasizing your scale and having more of a global reach to meet these demands.
I would echo what Bob and Mark have both said. I think that we're in a little bit of a state of flux where the market had changed considerably. The third-party capital entering, particularly the property catastrophe space, has pushed other companies to diversify that used to get a lot of their earnings from that. And you've seen ROEs trend considerably lower, combined ratios trend a little bit higher. And I think now that we've almost reached the state of equilibrium where it's moving on to another phase of development.
Mario, what are you seeing there?
Yeah. I see a market which is rational in the short term, and after, as Bob mentioned, after 2 years of cat losses and risk that were not properly modeled, such as the California wildfire, that had to be expected. Having said that, the ability to withstand the price improvement has to be demonstrated. January 1st, 2020 is going to be an important observation point. given the strong rebound also in investment market in the first half of this year, which is propping up the capital of the traditional reinsurance business, and also a number of players like PIMCO, which are entering the alternative capital market. So short term has been rational, but longer term, my view is that the non-life reinsurance industry is still too fragmented. As a comparison, the top 6 life and health reinsurers control 90% of the market. In non-life, there is a lot of degree of fragmentation. So I'm very cautious on the rebound we have seen in the first 6 months, and I expect the longer term the industry to further consolidate as a smaller player try to increase their balance sheet size and improve the diversification benefit of the underwriting portfolio.
Mario, the interesting point is that the equity markets did have rebound, but as you know, most global reinsurers really don't have huge equity portfolios outside of the alternative asset reinsurers. But the other interesting comment is interest rates. Interest rates have been low for a long time, and at the same time, really pricing has continued to compress. So we've seen that manifest itself in lower ROEs. Now, there was a little bit of hope that interest rates would be rising for a short period of time, but that seems to be off. Not going to happen now. The Fed has given a comment yesterday indicating that they may actually do a cut at the end of July. So if there's no hope for improved investment returns and we've had a series of losses, it would seem to me that there is going to be more pressure on underwriting discipline, certainly for the traditional players. I guess the other aspect of this is with lower interest rates, it might bring more alternative capital into the reinsurance space. So I don't know whether you guys feel there is a hope that things can get substantially better from where they are right now.
Yeah, I'd echo the sentiment that alternative capital, I think, will come back in a larger way now with lower interest rates as companies are looking for additional yield, additional spread, and it diversifies nicely against equity risk. So that'll be an additional pressure point, but it'll emphasize the need for underwriting discipline because with the reduced investment income component, it really puts a lot more pressure on technical results moving forward, especially with this type of loss experience that we've seen in both cat and casualty lines of business over the last couple of years.
Yeah. Would you agree that casualty is basically running at above 100?
Yeah, I'd say in general.
Right.
I'd say in general, there's been some disappointment in how it's performed the last few years,
right.
And we're definitely seeing increases.
Right.
Casualty reinsurance or casualty primary?
Casualty reinsurance, yes. So if you look at the combined ratio performance of most of the reinsurers, generally. And again, it depends on business mix, but if you think about the larger players, they're generally running about 100 combined. I think SCOR is an exception there. I have to give you credit there. But certainly Swiss and Munich. And you have to keep in mind that there are better performing classes of business, generally the shorter tail classes in that mix. So if you strip out those better performing classes, it indicates that casualty is probably well above 100. And given where interest rates are, it's really not generating a sufficient economic profit.
I agree, Bob. I agree that casualty is running above 100, but in the U.S., at least what we are seeing, our European casualty book is running extremely well, and well below 100. And this highlights the importance of the diversification of global insurance, which can have access to different sources of risk in different geography, to be able to leverage the different part of the cycle in the different product and market.
So let's follow up on the alternative capital discussion. It's somewhere between $90 and $100 billion today, but has been primarily focused on U.S. property cat. Do you see that expanding?
I'll start off. I've certainly heard about initiatives to try to go there. From what I gather from conversations I've had with industry participants, I think some of the traditional players would like to find ways to engage alternative capital, especially given the profit dynamics that we just spoke about, the longer tail classes of business. But I think that investors are reluctant because there's less certainty. The longer tail makes them less likely to want to participate in that particular space. So,
I guess you would probably have to come up with some mechanism where you could, have a definitive end to when the investor is exposed, and then send it back to a rated balance sheet, whether it's an LPT or an adverse development cover, or some ways so that they can get off risk. And we've seen that even with shorter classes of business, shorter tailed classes of business with trapped capital. It's a different, contractual relationship there.
Yeah, so that's an interesting point. I mean, I think that some investors were probably surprised by the tail or the duration of the liabilities associated with what has been termed short-tailed classes of business. So if they're not comfortable as a result of the impact from these cat losses in 17 and 18 and the tail associated with that experience, they've got to be questioning, well, why am I really willing to go into really longer tail classes of business?
Yeah, ultimately, I think the risks have to be quantifiable and modeled, and probably with a shorter loss development period. It's difficult to see how an investor is going to have the appetite for that longer period of time and the risk associated with it. So my sense is that there's probably a predisposition to sticking with property cat or shorter tails when you're looking at ILS or alternative capital.
I agree. There have been multiple attempts to place long tail business on alternative capital vehicle, but very few have been successful. And the reason, as Scott mentioned, is very difficult to commute, because typically there is an asymmetry of information where the reinsurance knows more than the third-party capital investor in commuting, and so there is skepticism in that. Also, a lot of investors like the ability to have yearly liquidity. For longer tail classes, you compete with private equity or with other long-term classes which generate double-digit IRR in the current market. Historically, that's been the case over the past 10 years. So the hurdle is much higher for this capital to flow in the reinsurance space. I do not think this trend will change in the near future.
What is driving the trapped capital? How did it get stuck in the first place?
Well, it's contractual, correct? So when a loss occurs, there are loss estimates associated with the event. The reserves are put up, and the collateral is basically there to back those potential future obligations. And it takes many months, maybe even years, to settle some of these losses. So the claim obligation remains, and until that claim obligation is satisfied or relinquished, the capital is trapped to back or to honor that potential claim. So right now, I think my recollection is at the beginning of the year there was about 20 billion. I'm seeing estimates that it has declined to 15, which I guess makes logical sense. Claims are being settled as time goes on, and some of that trapped collateral is doing one of two things. It's either being used to pay the claims, or it's being contractually released because there's the perception that the obligation has been satisfied.
I think it raises an interesting question in terms of the emphasis that some companies put on using alternative capital. So whether they're changing their initiative as a risk retainer, a risk carrier versus a risk transformer, and leveraging alternative capital to lay off the risk. When you have significant nat cat activity or the collateralization issue pop up, it can really create volatility in the capacity that they have, and that impacts directly on their franchise question in terms of providing gross capacities of a larger scale and that heavy reliance on alternative capital. So we've made a very conscious decision on our side at SCOR to have a very balanced approach between traditional retro and alternative capital to avoid this kind of dynamic.
Yeah, I think that kind of makes the argument for, if it's okay to have alternative capital, but potentially there should be a rated fronting carrier to that collateral so that the client, right, is being serviced, has no issues or no concerns, and then it's really up to the reinsurer or the rated carrier to basically, facilitate the collection process from the investor. And it also provides a stability in the capacity that is going to be provided, so that if investors exit, I would imagine that would make the pricing dynamic a little bit different, maybe more attractive, and you would be willing to actually retain that risk rather than pass it off to an alternative capital vehicle.
Yeah, just as a side note, I do think that larger banking institutions will provide you with a facility in case you have trapped collateral. It's essentially like a lending structure if you wanted to exit, but obviously it comes at a price.
Sure.
Is this capital trapped after a parametric trigger?
Well, I think the triggers could either be indemnity or parametric. I think the collateralization mechanism is probably similar. I'm not that much of an expert, but that's the way, thinking about it, I think that's the way it would work similarly.
I'm just thinking if it was a parametric trigger, it should be pretty simple whether that device was triggered.
Well, I guess there's more certainty when you have an indemnity trigger as to whether or not a loss has occurred. Parametric, right? A parametric trigger may not be triggered immediately after the event. So let's use Jebi as an example, although I assume that there were some parametric triggers, although I'm not certain. So that event took a very long time to develop. So months after the event, parametric triggers may not have been invoked. But then 6 months after the event, as losses emerge, the parametric trigger could in essence be invoked, and then the collateral will become tracked. I guess the danger in that is early release of that contract prior to knowing that the trigger, has the potential to actually be invoked. I don't know if you guys have anything to. I don't know if
exactly. I think you put it succinctly. That early release now is quite. We've seen some examples of that in the marketplace, and that's the risk that's on everyone's radar.
So turning to the rate of return, what's an acceptable rate of return an investor should expect given current market conditions?
Well, I would probably or eventually defer to Mark or Mario, but generally I think it's about 5% above the risk-free rate. So if you're thinking about U.S. Treasuries, and as you take on more risk, that's going to tick up, and if it's going to be less risky or perceived to be less risky, you probably accept something a little bit lower.
I think it depends largely on the risk appetite of the investor.
Probably the time horizon as well.
Yeah, and the time horizon. Plus, I mean, it's an uncorrelated risk with equities. Generally speaking, the lion's share, anyways, and the diversification benefit that some institutional investors, pension funds, receive from it is huge. So it really reduces, I think, the capital factor that they would apply against it, and hence what might be perceived as a lower margin for the risk is more attractive because of that diversifying element to it.
Because as we were talking about with the parametric trigger, if it's a wind speed of a Florida hurricane, it doesn't really correlate with the wider macroeconomic environment. Is that fair to say?
Yeah, exactly.
I will echo, Scott's comment. 5% above risk-free rate for a well-diversified property cat portfolio is what investors are looking. Then there are investors that seek higher return, and they put some financial leverage on this. But to Mark's point, there are a huge diversification benefit, and these investors are happy with this margin, which is below our cost of capital. So for certain risk like property cat, pension fund balance sheet are probably a better balance sheet than our balance sheet to host that risk. And to Bob's point, you may envisage us as being a rated balance sheet to be able to intermediate alternative capital, which is actually what is occurring. If you really look at alternative capital flow, they are really shifting from the ILS hedge fund to the traditional reinsurance industry, exactly for the reason Bob mentioned. This comes with risk, because typically the collateralization is up to 1 in 250 years event. That's at least how we collateralize in PartnerRe. And so in doing fronting, reinsurer will be taking a tail risk, 1 in 500, which will have to be managed.
Following up on what Mario said, is there you think a preference for ILS investing versus traditional reinsurers from investors?
Well, again, I think it depends on risk appetite and maybe even commitment or your long-term view of the market. I think that we think about historically, after a huge catastrophe event, it was common for investors to form startup reinsurers, usually in Bermuda. We don't see that happening anymore, and I think the reason being is that investors prefer greater flexibility in terms of committing capital to the sector. So I think that certainly is one of the reasons why fund managers have increased in number and size over the past several years versus committing capital to a traditional balance sheet type of formation.
And there's probably some element of additional complexity when dealing with catastrophe bonds or other insurance-linked securities. Not that equity investing is some simple, easy task, but there is a little bit different than what you would do if you were doing traditional investing.
There might be a bit of a niche investment principle for the reinsurer aspect of it in terms of your view on interest rates in the long term, because we're clearly entering another low interest rate environment for at least the short run, the foreseeable future. And so if you have any expectation of either a sharp increase in rates or a rising rate environment, that would make the reinsurance or insurance sector that much more attractive to equity investors.
So the pace of change in the insurance and reinsurance industry is accelerating. It's impacting all areas. What factors do you see as having the greatest potential to impact the overall market dynamics in the next 5 years, and why? We start with Mark.
Yeah, we've seen the huge impact of technology over the years. You can go back 60, 70 years ago with the advent of mainframes and computers, then CAT modeling, the internet. Now I think the emphasis is much more on data, big data and data analytics that comes from it, and how you can apply it in your business model in terms of assessing the risk, managing the risk on your balance sheet, and then helping your client by adding value from what you've learned in terms of the underwriting and the kind of services you can provide your client. So I see a continued emphasis on the data analytics side, both for life and for P&C risks. I think you're going to get most of the impact, at least at the beginning, through the distribution side of the business, followed by the primaries and then the reinsurers to a lesser degree. But there's no question the impact of technology and its rapid transformation is just going to keep going for the foreseeable future and be very impactful. And so I think if you've got the benefits of a real value proposition for your clients, and you have the scale and the reach and the benefits that come with diversification, you'll be well placed to manage that change.
Do you think that ultimately it will help reduce distribution cost or acquisition cost? I mean, that should ultimately, I think, when you think about technology and its impact, it seems to me that it will have the greater impact, in the brokerage agency model, and then the primary, and then to the lesser extent the reinsurer. But the cost savings at the bottom should benefit the entire chain. And I don't know, I mean, I don't see any evidence. In fact, I see somewhat to the contrary. I mean, a lot of companies are making a substantial initial investment, so it's driving the expense ratio up a little bit. But I guess my question is that are the producers, going to be willing to accept lesser commission, as their costs theoretically should come down?
Yeah, that's difficult to envision under any circumstance. I think that's the real question, but market forces are going to define that. Ultimately, when you're, regardless of what your role is, primary, reinsurer, broker, you truly have to justify your value proposition to a client. Otherwise, I think your long-term purpose in the industry is questionable.
Mm-hmm.
Mario, what are your thoughts on how technology is impacting the industry?
I think the biggest impact will be on primary distribution, less so reinsurance, because the broker have a strong market power in our industry. What I can see in terms of reduced distribution cost is industry consolidation. That may play a better role than technology. Life and health reinsurance, the top 6 life and health reinsurance in the market control 90% of the business. And most of the distribution is direct, it's not broker intermediated. So you may envisage that if you have consolidation in the non-life reinsurance and you end up with 5, 10 larger reinsurer, you may start seeing a more direct approach to client, helping disintermediate the brokers. And Swiss and Munich already have some form of direct distribution, but I see this as more a form to reduce distribution costs for our industry than technology.
So Mario, following up on that, there does seem to be a move for everyone to get closer to the risk, closer to the clients. You're seeing more primary writers have a direct business, more reinsurers want a direct primary line. How do you see this unfolding?
Yeah. Basically, having reinsurance entering the primary insurance sector increase your access to risk. That's a matter of fact. Now the question is, can you do this profitably, and at which cost in terms of damaging your existing distribution with your client base, with whom you are going to compete? At PartnerRe, we made the choice not to be in the primary insurance sector. We felt we could not be a player in the primary sector profitably because they are two different business. You know, insurance is data intensive, IT intensive, claim intensive, distribution intensive. Reinsurance is not. So we decided that for us, having access to a broader pool of risk but not being able to be profitable was not the right decision. We are seeing a lot of competitors doing this in a respectable way. What we are seeing is that we are benefit from a distribution perspective from the fact that we do not compete with our client, and we have gained market share toward reinsurer which have a primary reinsurance business model. So we are fine with our market position in this distribution space.
I would echo Mario's comments. It's very consistent with what we're doing at SCOR. We certainly don't want to compete with our clients with primary business. I think the real issue if you enter the primary side, whether it's personal lines, commercial, or specialty, is can you bring any kind of competitive advantage to your business case for it? So we're much more focused on the reinsurance aspect with some emphasis on specialty risks.
You know, it's an interesting, and again, I agree with Mario 100%. I think he makes a very interesting observation in terms of the profitability of insurance for those reinsurers that have entered the space. Again, going back to 2001, 2002, when we saw the hybrid model really start to take off, we as a rating agency actually thought it was would be favorable in terms of getting closer to the risk, having access to the risk, and having broader distribution capabilities, and therefore broader geographic spread of risk, right? But if you look at the profitability of the insurance segment of most of these hybrid companies, it really has been the reinsurance sector that has produced the greater profitability, and in many cases the insurance segment of the business has actually been a drag. So I do think that there's still a benefit to diversification and having multiple channels of distribution, but they do have to be profitable. You have to find a way to do it profitably, and if you can't, then I think the conclusion that PartnerRe came to in SCOR, maybe it makes sense to stick to your knitting and do what you do best.
PartnerRe and SCOR are in the minority, though.
That's very true.
I mean, the vast majority of companies are trying to do that, and as Bob said, with varying degrees of success.
So we've touched a little bit on market cycles. Can we explore that a little bit further? We used to see very dramatic highs and lows and hard and soft markets after major events, and things seem to have kind of leveled out there. Do you see a return to those dramatic market swings going forward?
I mean, I think it's, at least in the foreseeable future, it's unlikely. Some of it's a function of the abundance of capital, as we've talked about. We do a project with Guy Carpenter about dedicated capacity, and as a side exercise, we look at excess capacity. When you use our capital model, basically we start to pull out. We do an aggregate BCAR, so it's not just reinsurance; it's primary business, as we just were talking about, of reinsurers, and we pull out as much capital as we can till it gets to what we would consider a critical level. And last year the estimate was just under 250 billion. So I mean, there's a huge amount of capital, and certainly the supply and demand dynamics I think are at the forefront. And I'd be curious to know what, again, Mario and Mark thought about this, but I think to some extent solid and good risk management has also subtly played a role in it, where good risk management has reduced the volatility on the downside. And so there's sort of a corresponding effect where, since the downs are not as dramatic as they have been in the past, the upswing is correspondingly not as dramatic as it has been in the past. So just something could be playing a factor.
I mean, I agree with everything Scott said. I think, there's always the possibility of a cycle. It really depends on the magnitude of loss and the capacity to meet the event, right? So if there were to be an outsized catastrophe combined with, a financial crisis or an economic crisis, it's conceivable that you could have a hard market cycle. It's not out of the question, right? But I think given the fluidity of capital as it exists today, there are going to be cycles, but they're going to be more subtle. And I think that's just the reality of the market dynamic as it exists today.
Yeah, I would echo that. I don't think we've seen capital events, at least generally speaking, in the market from the last 2 years that would influence that equation. But I do agree that it's a more subtle approach going forward. It's pretty easy for alternative capital or traditional capital to enter following whether it's a Nat Cat event or potentially some sort of other crisis that impacts the industry.
And we talk a lot.
I will echo.
Go ahead. No, go ahead, Mario.
No, go. Go.
No, I think that we tend to talk about alternative capital as a source of competition, and indeed it is. But the reality, when you look at 17 and 18, the traditional players did benefit from the utilization of alternative capital. So yeah, everyone was at well above 100, certainly in 18. At or approaching 100. I'm sorry, in 17 well above 100, in 18, at or above 100, slightly above 100. So I think that if you didn't have that alternative capital as retrocessional capacity, those combined ratios would have been much higher for the traditional market. So they indeed did benefit, from utilizing it.
Yeah, I mean, you can just look back to 2011,
right.
And the swings were quite dramatic at the time. Different events in different geographies, but still overall, large events that seem to have a greater impact on earnings and underwriting results.
Mario, where in the cycle do you think we are now?
Luca, I echo Scott and Bob's view. I don't think there is going to be a cycle unless there is a combination of a capital event and financial crisis, given the leverage we have to investment in our balance sheet. So we are working to earn our cost of capital under current market condition, and this can be done. It's very difficult. It's much more difficult than what you used in the past. But that's the environment I think we need to prepare to work in the reinsurance industry, at least in the foreseeable future.
Mark, where do you think we are in the cycle today?
Yeah, I'd agree. I mean, we're coming out of the trough and entering a more hardening environment on the P&C side. Clearly, we haven't had the capital event, Nat Cats, that would create a more fundamental change. But then the other headwind that I think can't be underestimated is really this interest rate environment, this low yield interest rate environment, which I think will really have a negative impact on the market, both in the casualty side and just the general performance, P&L performance of companies in the industry.
So we hear a lot about the insurance gap. There are some obvious areas where the insurance, reinsurance, and alternative capital could and probably should innovate: cyber, flood, renewable energy, infrastructure, maybe replacing the government-sponsored FAIR plans, the plans of last resort. How do you see the industry progressing in these areas, or will they continue to kick the can down the road?
I think it's challenging. It's tough. I think you have to have two two items, two issues that are fulfilled. First of all, the insured has to want to pay for the risk, or the government has to mandate coverage of the risk. So that's part one. And then part two, the insurer or the reinsurer has to have the willingness to underwrite it. So you need both of those to coincide in order to create the necessary market. There's clearly insurance gaps all over the world, not just here in the U.S. We at SCORE work with government agencies to try to identify those gaps and put forward solutions, but it's not easy. Typically, the major hurdle that you run into is really the political and legislative will of a government to move forward on these items. So I'm a bit more reserved in how far we can advance in the near future anyways.
With government involvement, I mean, it makes it difficult at times to get proper pricing. If the government is providing that coverage now, it's normally not for underwriting profitably, whereas the commercial market would obviously look to make money on it over the long term.
I guess that one positive sign is that some of these government-sponsored pools, the NFIP in the U.S. is buying traditional reinsurance, not even more for the first time. I guess it was maybe 2 or 3 years ago where they first bought cover, and my recollection is they are increasing the limit. But again, I don't believe it's been profitable for the participants because of the number of losses. So I think that just proves the point that the pricing is not adequate, and the government really needs to. I guess somehow they need to become more motivated in order to ensure that there's adequate pricing for the risk, and that would certainly draw the commercial market in a more significant way. But again, I don't see how it's going to happen.
Mario, do you have thoughts on that?
No, I will echo. I think I don't have anything to add. I agree. It's very slow, and there are a lot of hurdles. I think we cannot count on closing the insurance gap in the short term, at least in the next 5-10 years, to improve our industry demand. That's not going to happen, in my view.
So AM Best has been working very hard on evaluating innovation. It has a new innovation criteria in the works. Bob, where are reinsurers showing their ability to innovate, and where do you see the need for them to focus?
Well, in terms of sectors within the larger insurance industry, I actually think the reinsurance sector has been the most innovative over the long term. I mean, if you think about how the models have evolved, that's first and foremost. The model has evolved in order to keep pace with the dynamic of the market. Now, that's encompassed some technological advancements. I think Mark highlighted some of them in his earlier comments. But by and large, it's ways to develop products and services that add value to the client. And I think that it's a very competitive landscape, and I think that reinsurers, in order to maintain their leadership role with their clients, they've had to innovate. They've had to be able to find ways to enhance their products and services or risk getting left behind. And increasingly brokers are playing a role in that too. They're providing services too. And I think that obviously there's a relationship between the reinsurer and the broker, and together they're finding ways to build on the relationships that they have with the cedent. So again, technology important, but I think it's more of the innovation of the model itself that has played a greater role. And then sourcing capital. I think that's the other aspect, certainly over the past 5 years, finding ways to improve capital efficiency, to reduce cost of capital, to use alternative sources of capital where the risk doesn't match the balance sheet return expectations. Those are other areas where I see a lot of innovation going on.
Yeah, I would agree with all of that. I think reinsurance, while I agree with everything Mark and Bob said as far as technology being important, it's when you think of the traditional technology in InsurTech, it's more of an app, and normally lends itself to more commoditized business, whereas reinsurers are sort of outside of that space, generally speaking. And so more of that goes into the data and analytics and really trying to become more profitable or reduce expenses.
I mean, a number of reinsurers have made, deliberately headlines in terms of, finding ways to digitize and source risk at the primary level, either on for their own behalf or on behalf of their clients. So, I mean, that's just another avenue that is certainly emerging. Obviously, it takes, you have to make an investment to do that. You have to have the resources to do it. So, and then there's also those reinsurers that I know that want to wait and see and how this develops.
Being a fast follower isn't necessarily a bad thing in that.
Bad position to be in. Because as Mario highlighted in earlier comments, a lot of reinsurers have entered the insurance space, but not profitably. So the question is will all of these initiatives in digitization and accessing primary risk really be done in a profitable way?
Mario, where are you seeing?
No, for me, Bob made an interesting comment, and I think we are in a syndicated industry. So either we are able to provide value in terms of know-how, pricing capability, ability to price risk to our client, or we will become a commodity. And I think over the past 20 years, reinsurance have enjoyed a double-digit ROE. It has really been a golden period for the reinsurance industry. And there has been a sort of complacency in the industry that we cannot innovate because the returns are going to be there. And I think our client and the broker, to Bob's point, have become more sophisticated, and now we are lagging behind as an industry. So in terms of risk selection, in terms of client product segmentation, I think we have to invest in understanding better those topics. And these don't require massive investment in IT technology, but are important factor for us to consider. The second point, which gives us in a syndicated industry a competitive advantage, is cost of capital. So we discuss about alternative capital in the property cat space. However, as a reinsurer, we need to ask ourselves, what are the risks that are better placed in our balance sheet compared to the risks that are better placed on someone else's balance sheet? So, for example, we are a large mortality writer in Canada through the Origin acquisition PartnerRe did in 2017. You may well argue that our mortality risk in Canada is better placed on a Canadian pension fund, which has longevity risk, and hence it will be a better hedge for their portfolio compared to our balance sheet. And I think understanding this will provide you a competitive advantage in terms of cost of capital, which is essential for the reinsurance industry to be able to avoid to be commoditized in the future.
Yeah, I couldn't agree more on that second point in particular. The product development side, I think, is well known in the industry, but what might be understated somewhat is exactly the cost of capital issue that Mario is raising, and the benefits that you get, particularly with when you're scaled as a reinsurer, to be able to understand those risks and how to lower your cost of capital through diversification, risk selection, and so forth. And that's going to make you more competitive in the marketplace, and then obviously more profitable in the longer term. So that emphasis to me is never ending. You're always seeking to arbitrage to a lower cost of capital over time, as well as the client aspect that you started off with in your answer.
Do you think the low interest rate environment in that regard helps, where you can issue securities at perhaps a lower interest rate, helps to keep cost of capital down?
I think that's a secondary aspect of it. I think that's more kind of the financial engineering of the day. So we've certainly taken advantage of a low rate environment to issue hybrid capital in Europe and in the States. So that's going to reduce it for probably the next 10 to 12 years until the refinancing comes up, and who knows what kind of monetary environment we're going to be in. But I think the fundamental competitive advantage is really unique to each company in terms of how they build their risk portfolio, and obviously being more global and scaled helps you in that respect. So,
Scott, one bright spot for the reinsurance industry is after a period of relatively static cession rates. Primary insurers seem to be buying more reinsurance. What's driving that?
I mean, I guess it could be considered a double-edged sword in some regards. I mean, it could, or is at least partially a function of the low pricing environment where, you know, for lack of a better way of putting it, you know, reinsurance was on sale for a little while, and why not get additional coverage? I think that's where the underwriting discipline really comes in, where, you know, reinsurers need to be able to weed that out where they're potentially being ceded less profitable business because of the pricing environment. So certainly that's, again, where good old school underwriting is really important.
I guess, you know, from my perspective, certainly in the U.S., and I'm not as familiar with the European market, but, you know, we've had a series of cat losses in 17 and 18, notable ones, but there's also, you know, a lot of smaller events. So I think we've certainly seen an increased appetite for aggregate cover because of the frequency aspect of these losses. And then I think the severity that came out in 17 and 18 also, I think, has driven some clients to want to, you know, protect themselves against earnings volatility. So, but I think that that's somewhat temporary. I think that, you know, after events, they tend to be more conservative. And they're paying, you know, they should be paying more for that. But then, you know, if the weather, you know, is more cooperative, that appetite could dissipate over time. I guess it remains to be seen.
Ultimately, I think you're trying to create real value with your client both ways. You really don't want to take on risk that ultimately is not sustainable because it's loss-making business. But you're trying to provide either protection against volatility of earnings or protection against capital or some sort of solvency solution. But that has to be a sustainable relationship for both sides in the long term. You might get a little bit of this cyclicality following events where maybe certain clients or primaries were underinsured, under-reinsured in the marketplace, but I think the principles that I laid out up front are what's going to drive it in the long term.
My view is that it's a combination of both. Certain insurers have cut, you know, there have been in the US no cut for 10 years, you know, from 2005, Katrina, to 2017. It has been a pretty benign environment. And so I believe most of the insurers reduced cession rate because they saw reinsurance as an expense and not as a capital tool. And this has reversed after the 17 and 18 event, to Bob's point. I also believe that there is a component that certain insurers are exploiting a soft market in reinsurance. They know very well their risk. They are arbitrating the reinsurance industry. And that's where really underwriting discipline is very important. So I think it's a combination of both. So investor and analyst needs to be very careful in analyzing the quality of the growth of the reinsurance industry to understand if it's really quality growth related to increasing legitimate needs from the client compared to arbitrage of cheaper insurance capacity in the market.
So we've had a lot of consolidation in the industry in recent years. How is that impacting the market overall?
I mean, I think it has a significant impact, and sometimes it's good, sometimes it's bad. It's probably somewhat neutral, and much like we've talked about the underwriting cycle, I think there is, to some extent, a M&A cycle, whereas market conditions change. You know, and Bob had mentioned in the past, you know, the old cycle used to be where capital would flow in, and there would be a bunch of Bermudians created, and then as those companies have come, we've also seen a lot of those go. So I think there is a cycle there. I don't necessarily think that being bigger is better. I think that there's a lot of risk in taking large companies and bringing them together, whether it's not just legacy systems and making sure that the accounting and finance is talking to underwriting properly, but it's also the cultural differences, and managing that, I think, tends to be more difficult than managing the technology and the more technical side of it.
Well, I mean, bigger is definitely not always better. I think that, you know, there are organizations who do acquisitions and do them quite successfully, and I think coincidentally of SCORE, I mean, they have done a number of life acquisitions, and The integration process has done very, very well, and they've proved to be, a profitable component of the organization and partner. Recently acquiring a life operation in Canada. Again, I think it was small, very digestible, almost seamless, quite frankly, from my perspective, in terms of integration. But there are some large deals, that have happened recently where I think the integration process is extremely difficult. And I think that the profitability has not been as accretive as I think management would have expected, and I can say certainly as far as we would have expected. It hasn't been as accretive or timely, in terms of execution. So I guess the larger the acquisition, the more difficult. I guess that makes logical sense. But it doesn't, one plus one doesn't always equal two. Sometimes, in rare instances, it can be a three, but that's more rare than the contrary. So, there's in the reinsurance sector in particular, everybody talks about relevance, and that's true. But you can be small and nimble and be relevant to your clients. There are a number of niche reinsurers or specialty reinsurers who have done an extremely good job. They've diversified out of necessity. They've done that generally through acquisition, have done it well, but they still maintain their core expertise and thrive. So and others just seem to become big and wallow.
Yeah, I think there has to be a good rationale for consolidation, M&A. There really has to be a franchise benefit to the marketplace to justify it. It can't just be some anticipated synergies, cost synergies, or capital synergies behind it. And the integration risk that you reference, I think, is quite relevant, whether it's social issues, systems, et cetera, cultural differences. Those are things that can really derail the benefits that are foreseen at the beginning and prevent a combination from really providing value to shareholders and the marketplace. Mm-hmm. In general, I do think there would be more of a consolidation, probably a trend to what we see on the life side, where you've got the top six reinsurers controlling 85 to 90% of the marketplace. Maybe it's not that quite concentrated on the non-life side, but I do see a trend in that direction. And as usual, I think over time you'll see smaller companies arise with specific niches of expertise that they'll be meeting market demand.
I concur, with Mark. I will say that in the short term, we are not seeing the benefit in the industry of this consolidation. And the reason is that also valuation paid for insurance company were very high. And so for this company, they want to preserve their top line in order to demonstrate that the acquisition, at least in the short term, has proved a good acquisition for the company and the shareholder. Over the long term, I foresee integration issue and hence retention of talent, which in our industry is very important. And also, particularly when you have large primary insurance acquiring larger insurance operation, the question of where do you allocate the capital becomes a complex question. And what history has taught is that you typically tend to allocate the capital to primary insurance, which tends to be more profitable. And hence, the reinsurance operation over time tend to reduce in size. And I think so the longer term consolidation is going to be good for our industry, although in the short term, as I mentioned, I don't see a lot of benefit in terms of improved industry environment.
So turning to Lloyd's, Lloyd's has announced a lot of new strategies and initiatives. Could we talk a little bit about the role Lloyd's plays in the reinsurance sector and how that is changing?
Lloyd's is, I believe, fourth largest reinsurer. It's a little bit misleading because if you think about the syndicates often roll up into other global reinsurers, so it's not just purely Lloyd's business. And it's essentially, they or help hold the line or not hold the line on that. I think if you also think about somebody like an AIG, it's very important from both from the primary side of it, what kind of business and how they choose to buy reinsurance. And on the flip side of Lloyd's, they're also a large buyer of reinsurance. So they provide and buy. So they're on both sides of the conversation there. So very influential, and it's obviously been a big discussion point about some of the performance issues there. So I think if and when that does start to flow through into the results, I think it should be at least somewhat of a help for the wider industry.
Well, I just echo that. When you think about Lloyd's results, I mean, I think that they're just indicative of the weak pricing environment that's existed over the past several years. It just seemed to manifest itself within that particular market in a more meaningful way. Obviously, new management, new initiatives, they all make logical sense. They need to execute. But because they're such a large capacity pricer, the discipline that they exercise through their underwriting, both primary and reinsurance, it's going to be a good thing for the market. It's going to help with the stabilization of pricing. And there's absolutely nothing wrong with that. We need it.
Yeah, I would echo the sentiment. They've had a couple of tough years in particular. They're undergoing fundamental change right now. I think they should keep renewing their focus on their platform for specialty risks, and maybe less focus on more commoditized lines of business where there's ample capacity in the market. Keep focusing on operational efficiency. So I think John Neal's the right guy. He's got a good strategy that he's trying to implement. We fully support him at SCOR. And my sense is he'll turn it around in given time.
And Lloyd's also doesn't get as much of a benefit from investment income as other organizations. So they are really reliant on underwriting to drive their results.
My view is that Lloyd's still provide an interesting platform for business. They provide advantage to access specialty risk distribution. They have a strong rating and a high underwriting leverage, which, to Scott's point, helps produce ROE through combined ratio rather through investment income. I think their biggest issue is their expense ratio. If you really look at expense ratio of Lloyd's platform is too high in a market where underwriting margin are low, and to our prior conversation on the cycle, it's unclear going to get significantly better in the near term. They are working diligently. They acknowledge this issue, which is important already, acknowledging that their expense has to be tackled. And for me, the critical to their success will be their ability to automate, reduce the expense ratio in order to be competitive in this market.
So reinsurers, specifically life reinsurers, have been very active in developing products and services that the primary insurers can use. Can we talk a little bit about those efforts? Maybe get into some examples of those, and do you see that trend continuing? Mark, can we start with you?
Yeah, sure. I think that that trend is natural. There's always a trend to product development. It's fundamental for the sector, whether it's life or P&C. On the life side, we have several examples. I can think of some cancer survivor covers that we're providing in Hong Kong that were developed recently. Here in the States, we're working with another carrier to try to provide term life covers for people with above average risk profiles, but who don't quite meet preferential rates, but they have healthy habits, lifestyle habits. And so with this kind of micro targeting, you can get a good risk and properly priced, and then capture that into your own portfolio. So those are examples of ways you can add real value to the market and then capture a risk that meets your own profile. On the P&C side, whether it's here in the States, I've seen some examples of flood covers, personal commercial lines. Latin America, South America, we've had product warranty covers, motor coverage in Colombia, new home warranty construction in China. So one of the good things is we've been able to take examples of something that's been developed in a Western market, whether it's in Europe or here in the States, and utilize it in emerging markets, whether it's Asia or Latin America.
Partner, we are doing the same. We are doing this through small acquisition. We made the 2 acquisitions. One is called Claim Analytics, another one is called Best Doctor. We believe that this entrepreneurship culture is better held in small company rather than within a large organization like PartnerRe. And we are helping mainly life reinsurance, our client, to analyze their claim, to understand patterns on risk or frauds. Or, for example, Mark mentioned, Hong Kong medical underwriting. For Best Doctor, we are really partnering with an insurer in China, to develop, critical illness or other complex coverage in really emerging markets. So really, you acquire know-how from this company and you try to leverage across the rest of your portfolio and globally. And really, this is important for us to do. You don't need to spend a significant amount of money. These acquisitions for us are mid-single-digit dollar million, but the potential and the know-how they bring to us and our client is very important. And that's, I think, a trend is going to continue for us going forward.
So Mario, Scott, Bob, and Mark, thank you so much for speaking with us today, and thank you for joining our webinar. We'll have a replay available later today, and we'll post a transcript shortly. For AM Best TV, I'm Meg Green.